So I really don't want to undersell the rest of the platform, but I think this is possibly the most important thing at this stage, at a fundamental level, at an introductory level, that I can speak to you about, and it's the flow of information through a set of financial statements. Why is it so crucial? Oh gosh, there's a whole bunch of reasons. One is your analysis. So one of the weaknesses in analysis is when analysis gets really blinkered. People start analyzing a transaction in the accounts, but where that transaction originates. Now, if you are aware of, or you have a good level of awareness that an originating transaction in the income statement potentially affects a whole bunch of metrics in that income statement, but also affects how it feeds into equity through retained earnings and onto the balance sheet, and how it can adjust maybe the capital structure on that balance sheet because of the transaction happening in the income statement, I think that's giving you a much broader, rounded, deeper view on the analysis. You're going to pick up on issues and get foresight that maybe other people miss because they're just very blinkered on what is happening in that income statement. The other reason is, I suppose, from a financial modeling perspective, a building perspective, from a valuation perspective, understanding how these transactions flow through to a valuation impact. And it's just also, I guess, a problem-solving situation because, you know, like it or not, we're all going to mess up our financial models at some stage. Hopefully less often than more often, but your models are going to break. You're going to do something silly. You're going to put the wrong sign in. You're going to miss out an entry. You're going to break a link, and then you've got to go through and try and find that error and have it not cost you hours and hours of time. That is a waste of time. Breaking models, I think, is part of life, but it should also be part of life that fixing them is an easy, methodical process you go through. And that methodological process really, for me, starts off with thinking about, right, what could I have done wrong? Where could have those impacts fed through? Because sometimes I'll see the symptom of the error maybe in the balance sheet, but the source of that error is actually in the income statement, and it's just me tracing the flow through the financials that allows me to get back to that situation where I find the source of that error. So this flow to me is essential. It's going to help you understand why your balance sheets are not balancing. It's going to give you a deeper understanding of your investment thesis and the analysis that is supporting it. And what we're going to do is we're just going to start it off by thinking about the income statement. Now, we talked about the income statement being a measure or statement of financial performance. There's an order to it. It's revenues, various associated costs. We get down to a whole bunch of different profit metrics, so earnings before and after tax, operating profit, EBIT, EBITDA, NOPAT, net income. Now, we'll mention net income because that's the bottom line in the income statement. That is a profit figure after all the expenses have been paid for, after all other providers of capital have been dealt with. That net income belongs to equity holders. It is theirs. They have that claim on it. The company doesn't owe that money to the equity holders, but it's a residual claim that the equity holders have. Now, that residual claim gets accumulated within retained earnings. Now, retained earnings is just the accumulation of this net income that has been fed back into the business. Now, out of that net income, yeah, there might be a dividend paid, right? After that dividend, we have leftover retained earnings. Now, it belongs to equity holders. Now, we've got to recognize that belonging somewhere else in the financial statements, and we do that over on the balance sheet. So retained earnings will feed down the income statement, go over to the balance sheet, and it'll be held there as a component of equity. Now, there's more and more of this picture to build up. We've got to talk about the cash flow. We've got to talk about the rest of the balance sheet, assets and liabilities, but we're going to build up this feeling of flow. So every time that you think about a transaction, literally, you've got these kind of ideas sparking in your mind, thinking that, right, the originating transactions is the income statement, but it's going to affect these metrics. It's going to feed through to these components of the financial statements. I've got to watch out what the implications are in the balance sheet, in the cash flow, down in equity. And I think then you've got a fantastic framework and mechanism to do some great analysis, fix models, move on, and really understand how information is flowing through ultimately into a valuation, whether that's a fundamental valuation or you're trying to figure out what is priced into the market, two essential parts of the investment process. All right, check out the next videos. See you soon. Cheers.